Question 1. Legal framework and regulations. Which of the following statements best describes the minimum capital and surplus requirements for captive insurance companies operating in Illinois? A. Captive insurers in Illinois must maintain a minimum capital of $500,000 and surplus equal to or greater than the initial capital. B. The Illinois Department of Insurance mandates that all captives maintain a minimum surplus of $2 million, regardless of their insurance lines. C. A captive insurance company in Illinois must have initial capital of at least $250,000 and must maintain surplus levels that ensure the company can meet its financial obligations. D. Captives are exempt from the minimum capital and surplus requirements if they purchase reinsurance to cover their risks. Answer. C. A captive insurance company in Illinois must have initial capital of at least $250,000 and must maintain surplus levels that ensure the company can meet its financial obligations. Explanation. In Illinois, the minimum capital required for a captive insurance company is $250,000. This is designed to ensure that the company has enough financial stability to meet its obligations. The surplus requirement is directly tied to the financial health of the captive and must be sufficient to cover its liabilities and risks. This ensures solvency and the ability to pay claims. The other options are incorrect as they mistake the capital or surplus amounts or incorrectly describe exemptions. Question 2. Scenario-based question. Mr. Turner is the owner of a medium-sized manufacturing business in Illinois. His company has decided to form a captive insurance company to handle risks related to property damage, workers' compensation, and liability coverage. What is the first step Mr. Turner should take in the process of establishing the captive insurance company? A. Submit an application for licensure to the Illinois Department of Insurance, IDOI. B. Hire an external auditing firm to conduct an initial financial audit of the business. C. Prepare a comprehensive business plan and feasibility study for the proposed captive. D. Immediately secure reinsurance agreements for the captive to ensure its solvency. Answer. C. Prepare a comprehensive business plan and feasibility study for the proposed captive. Explanation. The first step in the process of forming a captive insurance company in Illinois is to prepare a detailed business plan and feasibility study. This ensures that the captive will meet the business's risk management needs and that it is financially viable. The feasibility study includes an analysis of the types of risks to be insured, the initial capital requirements, and an understanding of the company's long-term financial sustainability. Submitting an application for licensure, option A, happens after the business plan and feasibility study are completed. Hiring an external auditing firm, option B, is generally done later in the process, and securing reinsurance agreements, option D, is not the first step in formation. Question 3. Financial operations of captives. How does the pricing of premiums for captive insurance companies typically differ from traditional insurance companies? A. Captive insurance premiums are generally low due to the reduced administrative and regulatory costs associated with captives. B. Captives use actuarial data to determine premium pricing. The premiums are fixed by the Illinois Department of Insurance based on industry averages. C. Premiums in captives are set based solely on the insurer's historical claims experience, with no need for external risk assessments. D. Premiums in captives are often set at a higher rate than traditional insurers due to stricter regulatory requirements and higher reserve requirements. Answer A. Captive insurance premiums are generally lower due to the reduced administrative and regulatory costs associated with captives. Explanation. Captive insurance companies often have lower premiums than traditional insurers because they face fewer administrative and regulatory costs. Captives are created for the benefit of the parent company, which helps to reduce overhead and marketing expenses associated with commercial insurance. Additionally, captives may have more flexibility in their underwriting and pricing, allowing them to tailor premiums to the specific risks of the business. While captives do use actuarial data to set premiums, the premiums are not fixed by the Illinois Department of Insurance, option B, nor solely based on historical claims experience, option C. The regulatory framework for captives is different from traditional insurance and premium rates are not necessarily higher, option D. Question 4. Risk management and underwriting. Which of the following best describes the primary difference between risk retention and risk transfer for a captive insurance company? A. Risk retention involves the captive company absorbing the risks directly, while risk transfer involves transferring risk to an external third party, typically through reinsurance. B. Risk retention refers to the captive transferring risks to the parent company, while risk transfer means that all risks are transferred to an external insurer. C. Risk retention is about transferring certain risks to external insurers, while risk transfer only applies when a company self-insures its risks. D. Risk retention requires the company to pay for all claims, while risk transfer means the captive has no financial responsibility for claims. Answer A. Risk retention involves the captive company absorbing the risks directly, while risk transfer involves transferring risk to an external third party, typically through reinsurance. Explanation. Risk retention occurs when a captive insurance company assumes responsibility for risks and losses without transferring them to an external entity. The captive retains the risk and pays for claims directly, which allows for more control and potential cost savings. Risk transfer, on the other hand, involves the use of reinsurance or other external contracts to shift part or all of the risk to another insurer. The options incorrectly define the relationship between the captive and external parties in terms of risk sharing. Question 5. Financial operations of captives. When calculating the required reserves for a captive insurance company, which of the following statements is true regarding loss reserves? A. Loss reserves are calculated only based on claims that have been reported to the captive insurance company. B. Loss reserves include an estimate for both reported and unreported claims, referred to as incurred but not reported IBNR losses. C. Loss reserves are determined solely by the Illinois Department of Insurance, which sets an industry standard rate. D. Loss reserves must be invested in government-backed securities to ensure they are easily liquidated in case of claims. Answer. B. Loss reserves include an estimate for both reported and unreported claims, referred to as incurred but not reported IBNR losses. Explanation. Loss reserves are set aside by captive insurance companies to ensure they can cover future claims. These reserves include both reported claims and estimates for claims that have occurred but have not yet been reported IBNR. Captives must use actuarial data to project these reserves based on past claims and expected future losses. The Illinois Department of Insurance does not set the specific reserve amounts, option C, and loss reserves are not solely invested in government-backed securities, option D. Option is incorrect as it omits the requirement for IBNR reserves. Question 6. Taxation of captive insurance. Which of the following tax advantages applies to a captive insurance company under Section 831B of the Internal Revenue Code? A. Captive insurers can deduct premiums paid to parent companies from their taxable income, reducing their tax liability. B. Captives electing IRC 831B can exclude up to $2.45 million in premiums from taxation as long as the insurance is risk-based. C. Captives are exempt from federal taxation if they pay at least 50% of their premiums to third-party reinsurers. D. Captives formed under IRC 831B must pay taxes on all premiums earned, regardless of the risk-sharing arrangements. Answer. B. Captives electing IRC 831B can exclude up to $2.45 million in premiums from taxation as long as the insurance is risk-based. Explanation. Under IRC 831B, a captive insurance company can exclude up to $2.45 million in premiums from federal taxation, provided the insurance is risk-based and the company is not primarily engaged in the business of underwriting. This section is designed to allow small captives to benefit from favorable tax treatment by reducing their tax liability. The other options either misstate the requirements, option A, or describe conditions that are not part of IRC 831B, option C and D. Question 7. Legal framework and regulations. What is the role of the Illinois Department of Insurance (IDOI) in overseeing captive insurance companies? A. The IDOI is responsible for setting the premiums that captives can charge to their policyholders. B. The IDOI monitors the solvency and financial stability of captives to ensure they comply with Illinois insurance laws and regulations. C. The IDOI handles all claims adjustments and settlements for captives operating in Illinois. D. The IDOI approves the specific investment strategies that captives must follow in their financial operations. Answer. B. The IDOI monitors the solvency and financial stability of captives to ensure they comply with Illinois insurance laws and regulations. Explanation. The Illinois Department of Insurance (IDOI) plays a key role in regulating captive insurance companies. Its responsibilities include monitoring the solvency and financial stability of captives to ensure they have adequate capital and reserves to meet their obligations. While the IDOI does regulate certain aspects of captive operations, such as financial reporting and solvency, it does not set premiums option A, handle claims option C, or approve specific investment strategies option D. Question 8. Captive insurance operations and management. Which of the following is an essential responsibility of the board of directors in a captive insurance company? A. The board must actively participate in the claims adjustment process and make all claims settlement decisions. B. The board is responsible for ensuring the company complies with relevant insurance regulations and maintaining adequate capital levels. C. The board has no legal responsibilities and is only a nominal body to fulfill regulatory requirements. D. The board of directors is responsible for selecting the specific insurance policies offered by the captive to policyholders. Answer. B. The board is responsible for ensuring the company complies with relevant insurance regulations and maintaining adequate capital levels. Explanation. The board of directors in a captive insurance company has fiduciary duties to ensure the company operates in compliance with applicable laws and maintains the necessary capital and solvency to meet its obligations. While the board may be involved in setting broad policies, it does not typically handle day-to-day claims decisions option A or select the specific insurance policies option D. The board does have significant legal and regulatory responsibilities, making option C incorrect. Question 9. Claims management and settlement. Which of the following is a key consideration when a captive insurance company is managing a liability claim? A. Captive insurers must immediately settle all claims in favor of the policyholder regardless of the merits of the claim. B. The captive must adhere to industry standard settlement practices, but it has flexibility in how it handles claims internally. C. Captive insurers cannot use outside adjusters and must manage all claims in-house. D. All claims must be handled by the Illinois Department of Insurance IDOI to ensure proper settlement. Answer. B. The captive must adhere to industry standard settlement practices, but it has flexibility in how it handles claims internally. An explanation. Captive insurance companies have the flexibility to manage claims in-house or hire external adjusters, but they must adhere to industry standard practices for claims settlement. This includes ensuring fairness, transparency, and compliance with relevant laws. The Illinois Department of Insurance IDOI does not directly handle claims option D, and captives are not required to settle all claims in favor of the policyholder option A. Option C is incorrect, as captives can use external adjusters when necessary. Question 10. Financial requirements for captives. What is the minimum capital and surplus requirement for a captive insurance company domiciled in Illinois under state regulations? A. $500,000. B. $1 million. C. $2.5 million. D. $3 million. Answer. B. $1 million. Explanation. The minimum capital and surplus requirement for a captive insurance company domiciled in Illinois is typically $1 million, which ensures the company has enough financial resources to cover its obligations. This requirement is subject to adjustments based on the type of captive and other regulatory factors. Question 11. Regulatory reporting for captives. Which of the following is true regarding the regulatory reporting requirements for a captive insurance company in Illinois? A. Captives must file quarterly financial statements with the Illinois Department of Insurance IDOI, regardless of size. B. Captives are only required to file an annual report unless they are considered large captives. C. Captives must file biannual reports detailing their claims handling practices and reserves. D. Captives must provide detailed monthly financial updates to the IDOI. Answer. B. Captives are only required to file an annual report unless they are considered large captives. Explanation. Illinois requires captive insurance companies to submit annual reports that include financial statements, information about claims, and details about reserves. Larger captives or those with more complex operations may have additional reporting requirements, but quarterly or monthly filings are typically not required. Question 12. Risk diversification in captives. Which of the following is a key requirement for risk diversification in a captive insurance company according to Illinois regulations? A. A captive must insure at least 5 different risks in order to be considered fully diversified. B. A captive must maintain insurance for at least 100% of the premiums it receives, ensuring complete diversification. C. Captives must diversify their risk pool by insuring a broad spectrum of risks and not concentrating too heavily on one or two types of coverage. D. Illinois regulations do not require captives to diversify their risks. Answer: C. Captives must diversify their risk pool by ensuring a broad spectrum of risks and not concentrating too heavily on one or two types of coverage. Explanation: while Illinois regulations don't mandate insuring a specific number of risks, captives must diversify their risk pools. This helps prevent a captive from becoming overexposed to a single type of risk, which could put the company's financial health in jeopardy. Question 13. Captive insurance business plans. What must a captive insurance company include in its business plan when applying for licensure in Illinois? A. Detailed risk management strategies, financial projections, and a description of its underwriting processes. B. An outline of potential claims in the first year of operations. C. A list of the parent company's other subsidiaries, regardless of relevance to the captive. D. Proposals for the specific types of reinsurance that the captive intends to use. Answer: A. Detailed risk management strategies, financial projections, and a description of its underwriting processes. Explanation: when applying for licensure, a captive insurance company in Illinois must provide a detailed business plan that outlines its risk management strategies, financial projections, underwriting practices, and other essential operational details. This ensures that the company can effectively manage its risks and meet regulatory requirements. Question 14. Risk-based capital (RBC) requirements. How is the risk-based capital (RBC) requirement applied to captive insurance companies in Illinois? A. Captives must maintain a minimum RBC of $5 million to ensure their financial stability. B. Illinois follows the same RBC requirements as other types of insurers based on the size and nature of the business. C. Captives are exempt from RBC requirements as long as they are not engaged in reinsurance. D. The Illinois Department of Insurance does not impose any RBC requirements on captives. Answer: B. Illinois follows the same RBC requirements as other types of insurers based on the size and nature of the business. Explanation: captive insurance companies in Illinois must maintain adequate RBC based on the size and complexity of their operations. The RBC formula evaluates a company's financial strength and the risks it faces, ensuring the company has sufficient capital to meet its obligations. This is similar to requirements for other types of insurers. Question 15. Captive insurance and reinsurance. Under Illinois law, what is one primary condition for a captive insurance company to use reinsurance? A. Reinsurance can only be purchased from insurers that are domiciled in Illinois. B. The captive must not exceed a specific retention limit without utilizing reinsurance to reduce its risk exposure. C. Reinsurance is mandatory for all captives regardless of their size or scope of operations. D. Captives are prohibited from using reinsurance except for catastrophic risks. Answer: B. The captive must not exceed a specific retention limit without utilizing reinsurance to reduce its risk exposure. Explanation: Illinois law allows captives to use reinsurance as a way to mitigate risk, particularly when they reach a certain retention limit. This helps to spread risk and ensure financial stability in the event of significant claims. Question 16. Captive insurance and claims handling. In Illinois, what is the primary responsibility of a captive insurance company when it comes to claims handling? A. The captive must immediately pay all claims regardless of their merit. B. Captives must establish and follow a fair and consistent claims handling process, ensuring that claims are reviewed and settled appropriately. C. Captives must delegate claims handling to an external claims administrator in all cases. D. Captives must report all claims to the Illinois Department of Insurance for review and approval before settlement. Answer: B. Captives must establish and follow a fair and consistent claims handling process, ensuring that claims are reviewed and settled appropriately. Explanation: captive insurance companies are responsible for developing their own claims handling procedures. These procedures must be fair, transparent, and in compliance with applicable laws. While the Illinois Department of Insurance may oversee the financial stability and compliance of captives, it does not directly manage or approve claims settlements. Question 17. Self-insurance versus captives. What is one key difference between self-insurance and a captive insurance company in Illinois? A. Self-insurance involves pooling funds from multiple unrelated entities, while captives are owned by a single parent company. B. Captives typically offer coverage for the parent company's risks, while self-insurance involves managing risk within a larger unrelated group. C. Self-insurance is regulated by the Illinois Department of Insurance, while captives are not. D. Captives are only for companies with multiple subsidiaries, whereas self-insurance is for any business entity. Answer: B. Captives typically offer coverage for the parent company's risks, while self-insurance involves managing risk within a larger, unrelated group. Explanation: the primary difference between self-insurance and a captive insurance company is that a captive is an insurer formed by a single parent company to cover its own risks, while self-insurance is typically used by businesses that prefer to self-fund and manage their own risks within a broader group or entity. Question 18. Illinois captive insurance application process. What is the first step in applying for a captive insurance license in Illinois? A. Submit a completed application form and pay the application fee. B. Secure a reinsurance agreement with an Illinois-based insurer. C. Submit a business plan and financial projections to the Illinois Department of Insurance. D. Hire a licensed captive manager based in Illinois. Answer: C. Submit a business plan and financial projections to the Illinois Department of Insurance. Explanation: the first step in applying for a captive insurance license in Illinois involves submitting a detailed business plan, which includes financial projections, risk management strategies, and an overview of the captive's operations. This is essential for regulatory review and approval. Question 19. Captive insurance and taxation. Which of the following tax benefits is available to a captive insurance company in Illinois? A. Captives are exempt from all state taxes on their income. B. Captives may deduct all premiums paid to parent companies for tax purposes. C. Captives can qualify for tax exemptions on investment income, but only if they reinsure with a third party. D. Illinois offers no specific tax benefits to captive insurance companies. Answer: B. Captives may deduct all premiums paid to parent companies for tax purposes. Explanation: captive insurance companies in Illinois, as in many other states, may deduct premiums paid to the parent company as a business expense, which can reduce their taxable income. However, they are not exempt from all taxes, and tax benefits do not extend to the broader scope of investment income without meeting specific conditions. Question 20. Captive insurance and the Illinois Insurance Code. Which part of the Illinois Insurance Code directly applies to the formation and regulation of captive insurance companies? A. The Insurance Company Holding Act. B. The Captive Insurance Company Act. C. The Risk Retention Act. D. The Illinois Domestic Insurer Act. Answer: B. The Captive Insurance Company Act. Explanation: the Illinois Insurance Code includes specific provisions under the Captive Insurance Company Act that govern the formation, operation, and regulation of captive insurers. This legislation outlines the requirements for licensing, financial responsibility, and reporting for captive insurance companies operating in Illinois. Question 21. Captive insurance licensure process. Which of the following must a captive insurance company demonstrate in its application for licensure in Illinois? A. A history of at least 3 years of profitable operations. B. Sufficient capitalization to meet all regulatory requirements and operational needs. C. A plan to offer coverage to multiple unrelated entities. D. The ability to pay all claims without external reinsurance. Answer: B. Sufficient capitalization to meet all regulatory requirements and operational needs. Explanation: a captive insurance company must demonstrate that it has adequate capitalization to cover its liabilities and meet all regulatory requirements in Illinois. The state requires financial stability to ensure the company can operate effectively and meet claims. Question 22. Illinois Captive Insurance Regulation. What is the primary function of the Illinois Department of Insurance (IDOI) in relation to captive insurance companies? A. To create and issue insurance policies for captive companies. B. To oversee the financial solvency and compliance of captive insurance companies. C. To act as the primary reinsurer for all captive insurance companies domiciled in Illinois. D. To manage claims filed by captive insurance companies. Answer: B. To oversee the financial solvency and compliance of captive insurance companies. Explanation: the Illinois Department of Insurance (IDOI) ensures that captive insurance companies maintain financial solvency, adhere to state regulations, and protect policyholders. IDOI also ensures that captives comply with operational and reporting requirements, but does not act as a reinsurer or manage claims. Question 23. Types of captive insurance companies in Illinois. Which of the following is a type of captive insurance company allowed in Illinois? A. Pure captive insurance company. B. Reciprocal captive insurance company. C. Group captive insurance company. D. All of the above. Answer: D. All of the above. Explanation: Illinois law allows for various types of captive insurance companies, including pure captives owned by a single parent, reciprocal captives owned by the policyholders, and group captives formed by multiple businesses to share risk. Question 24. Captive insurance and regulatory examinations. How often are captive insurance companies in Illinois subject to regulatory examinations by the Illinois Department of Insurance? A. Annually with a focus on financial solvency and operations. B. Every 2 years based on the captive size and complexity. C. Examinations are not required unless there is a complaint. D. Captives are examined only when they request a license renewal. Answer A. Annually with a focus on financial solvency and operations. Explanation. Illinois requires annual examinations of captive insurance companies to ensure they maintain financial solvency and comply with all applicable regulations. These examinations assess the overall operations, financial statements, and claims handling processes. Question 25. Reinsurance requirements for captives in Illinois. Under Illinois regulations, what is a key consideration when a captive insurance company enters into a reinsurance agreement? A. The reinsurance agreement must be filed with the Illinois Department of Insurance. B. The captive must obtain reinsurance from an insurer licensed in Illinois. C. Reinsurance is prohibited for captives with total assets over $10 million. D. The reinsurance agreement must cover at least 50% of the captive's liabilities. Answer A. The reinsurance agreement must be filed with the Illinois Department of Insurance. Explanation. Captive insurance companies in Illinois must file their reinsurance agreements with the Illinois Department of Insurance. This ensures that reinsurance arrangements are properly structured and that the captive meets regulatory requirements for risk management and solvency. Question 26. Captive insurance and taxation. How are captive insurance companies typically taxed in Illinois? A. Captives are subject to standard corporate income tax rates. B. Captives receive a tax exemption on all premiums and investment income. C. Captives are taxed only on their investment income. D. Captives are exempt from all state taxes if they are domiciled in Illinois. Answer A. Captives are subject to standard corporate income tax rates. Explanation. Captive insurance companies in Illinois are subject to the standard corporate income tax rates unless specific tax exemptions or credits apply. However, there are generally no blanket exemptions for captives, and they are taxed like other business entities in the state. Question 27. Illinois captive insurance reporting requirements. Which of the following must a captive insurance company submit to the Illinois Department of Insurance annually? A. An audited financial statement prepared by an independent auditor. B. A list of all claims settled in the preceding year. C. A detailed analysis of its reinsurance agreements and risk retention. D. A report detailing the number of employees working for the captive. Answer A. An audited financial statement prepared by an independent auditor. Explanation. Illinois law requires captive insurance companies to submit audited financial statements on an annual basis prepared by an independent auditor. This ensures transparency and helps the Illinois Department of Insurance monitor the captive's financial condition. Question 20. Illinois captive insurance insolvency protection. What happens if a captive insurance company domiciled in Illinois becomes insolvent? A. The Illinois Department of Insurance takes control of the company and manages claims. B. The captive's parent company is automatically responsible for covering claims. C. Captives are not required to have insolvency protection in Illinois. D. The Illinois Insurance Guarantee Fund provides protection to policyholders for covered claims. Answer D. The Illinois Insurance Guarantee Fund provides protection to policyholders for covered claims. Explanation. If a captive insurance company becomes insolvent, Illinois provides protection to policyholders through the Illinois Insurance Guarantee Fund, which covers claims within the limits of the fund. This fund helps protect policyholders in the event of a captive's failure. Question 29. Captive insurance and claims reserves. Which of the following best describes the reserve requirements for captive insurance companies in Illinois? A. Captives are not required to maintain claims reserves. B. Captives must maintain sufficient reserves to cover expected future claims liabilities as determined by an actuary. C. Captives can reserve only for claims made during the current year. D. The Illinois Department of Insurance sets fixed reserve levels for all captives. Answer. B. Captives must maintain sufficient reserves to cover expected future claims liabilities as determined by an actuary. Explanation. Captive insurance companies are required to maintain adequate reserves to cover future claims liabilities. The reserves must be established by an actuary to ensure they are sufficient to meet anticipated obligations. Question 30. Changes to captive insurance operations in Illinois. If a captive insurance company in Illinois wants to significantly alter its operations, such as expanding into new lines of insurance, what is required? A. The company must submit an updated business plan and receive approval from the Illinois Department of Insurance. B. No approval is necessary as long as the company continues to comply with minimum capital requirements. C. Captives must undergo a full regulatory review every time they change operations. D. The Illinois Department of Insurance requires the company to pay an additional annual fee for operational changes. Answer A. The company must submit an updated business plan and receive approval from the Illinois Department of Insurance. Explanation: any significant operational changes, such as expanding into new lines of insurance, require the captive insurance company to submit an updated business plan for review and approval by the Illinois Department of Insurance. This ensures that the company remains in compliance with all regulatory requirements.